Hello and welcome to the IWG YouTube channel. My name is Axel Meyerhöfer. I'm the founder of Ideal Wealth Grower and your host for today's episode. So in this video, I thought it's high time, or time again if you want to transition some of the information that I've been asked about quite a bit in lots and lots of podcasts that I've been on as a guest. To discuss a little bit, how does Ideal Wealth Grower actually work and the foundation for Ideal Wealth Grower. And oftentimes I start answering that question by making people aware that ideal in the literal sense would be this is the ideal way to actually start generating passive income and building assets, and it helps you when there is inflation, which we're all experiencing. In the last few videos you have probably seen and heard me talk about that and what the impacts are and so forth. So our out-of-state turnkey residential real estate investing strategy is an ideal way to develop passive income and have passive income basically for the rest of your life. If you keep following the journey, it's an ideal way to reach what I call the time freedom point. So the point in time where you no longer are required to exchange time for money, but you have the choice, you have the freedom to decide what do you want to do with your most valuable asset, which is time. That's something that you can't replace, you can't get it back. There is the same amount of time. I always say the same 168 hours a week everybody has. No matter what title you have, no matter how rich or poor you are, no matter where you live on the globe, that's what we have, 168 hours every week as long as we live. So that's basically the general idea to say, where does the name Ideal Wealth Grower come from? Now, grower is in two ways to be thought of. One is we want to grow our wealth in an ideal way. So that's how these three words actually fit together. But the other component is also the grower word as a model is also what I'm using for mentoring and coaching. If somebody says, hey, this out-of-state turnkey residential real estate strategy sounds really interesting, but it also sounds complex. And I looked at the Ideal Wealth Grower YouTube channel, and I saw every Wednesday they post these terminology explained videos. But that also shows me, we are now approaching close to 100 videos by now, that there's a lot of terminology, a lot of stuff to learn, and I learn better and like it when there is somebody who helps me along. So that's what we do in the coaching and mentoring. And to put that in a structure, I use the grower model, which comes from John Whitmore's original grow model that I expanded to turn it into the grower model for our purposes. Now, with that all being said about what is ideal, what do we grow as the wealth, and how do we do it by helping people following the structure of the grower model, Ideal also has another purpose in a sense, if you want to, and that is in the context of an abbreviation. And so for today's video, I wanted to take the first letter of that word idea, the I, because that is not just the I of ideal, but it also stands for something in the context of the abbreviation, and what it stands for is income. And I did a little bit of research on it because I had made the mistake to some extent to always assume, especially when people in podcasts or when I have conversations, somebody contacts me, we have a call, and you can, by the way, do this by just going to idealwealthgrower.com, and it automatically pops up and says schedule a strategy call, and then you and I will have a call with each other for like half an hour, or however long it takes, and answer your questions and see if you like to work with us. So in this context of income, I find oftentimes that people see that relatively narrow. And yes, it's not wrong to say, okay, when we're talking about income in the context of real estate investing or working at Ideal Wealth Grower, income is the money that comes into your account. But what is important to realize in this context is, where does the income come from? Because you could basically make the argument when we're talking about the passive income that that is a form of income too, and that is ultimately the goal. So you could separate income in multiple different categories, and one thing, just for the kicks of it, or if you want to have a little bit of fun, or if you want to surprise yourself, invite you basically, if you listen to this in the United States, you go on Google, you just put in income and IRS for Internal Revenue Service into the search. Now, if you're somewhere else in the world and you see this video, you probably need to put United States somewhere in the search term as well. And what happens is a page pops up from the Internal Revenue Service, from the tax people basically, that describes all the different kinds of income that can impact your taxes. And you will be surprised. I was surprised myself, even though I'm dealing in this stuff for quite a while, but there's even more different kinds of income that have not necessarily anything to do with what we're doing in real estate investing. And therefore, I'm not going to touch on them, but there is a ton of different types of incomes. So most people, when we use the word income, they think about active. And you could also call it work income. And that is the compensation that you get for your time. Now, even that is separated in the tax code, and I don't want to make this about taxes as much, but there is different kinds of income when you're trading time for money or for income. The one is called W-2 in the United States, which stands for you are an employee in a job and you have either hourly income, meaning like every hour is paid at a certain rate. Let's say your hourly rate is $50, right? And so if you work 40 hours a week and you get paid once a month and you have, let's say, 160 hours and it's $50, you get $8,000 gross income. Now then they're deducting the taxes and your retirement plan and all kinds of other fees and stuff like that. So you won't actually get those full $8,000, but whatever is the difference between the gross income and the net income. So that would be on an hourly basis. Now, a lot of people these days also work on what's called a salary basis, which means you negotiated with your employer and your employer said, okay, I like you to work for us in the following capacity: as a human resources person, or as a salesperson, or as a program person, or as a software developer, whatever the job may be. And instead of having to count every hour, we just expect you to work full time, like meaning 40 or 50 or 60 hours, however much it takes to do the job. So you don't have to count the hours, you just do the job as needed. And for working the hours, as many as it takes to do the job on a regular basis, we pay you, let's say, $5,000, $6,000, $7,000 gross income per month. That's called salary. So 1 week or 1 month, you only, let's say, need 10 hours a week, which is very, very rare. Or maybe next month 20, the next month 40. So the project is growing, but then there come months where it needs 50, 60, 70 hours a week, and your pay will always be the same. That's called salary. You get the same salary, the same amount of money every month, regardless how much or how little time it takes you to do the job. That is still, in a sense, trading your time for money, because in most cases, even on salary jobs, most employers expect you to be on the job, whether it's actually in their building, in their facility, or working remote from home, as we have all gotten more and more familiar with lately. They still expect you to be on the job during normal business hours, normal work hours, so something like 8 to 5 in the evening, or 9 in the morning to 5 or 6 in the evening, something like that, right? So that is your time, probably the most valuable and best time of the day, being sold to your employer, and they in return give you money. And that money, if you look at your tax return, is considered income, or you might also hear terms like I mentioned, salary. Some people also call it wages. So if you then, on the other hand, have a business and you employ people, whether it's for hourly or for salary, that is also considered wages, because those wages are an expense on your business. So that's one form of income, and that is the one that we are most familiar with, and that what most people think when we're talking about income in the context of the term ideal, or the acronym ideal. So I went ahead and made a little cheat sheet what other incomes are out there, because I think it's important, and they can all, or pretty much all of them, can be used in the context of out-of-state turnkey residential real estate investing. So you can take part of that income, whether it's hourly or salary income, put a little bit aside into what I call the accumulation account. You should at least do 10% before you spend any of that money on anything else. And as soon as you have $15,000, $18,000, $20,000, $25,000 together, you can purchase your first residential real estate property, meaning like a house or a duplex or a triplex or anything like that. Now, another form of income is dividends. So let's just say you have, before you started thinking about investing in real estate, you did some investments in the stock market, which if you have done that the last 10 years, you probably did pretty well, because the stock market has continuously been going up. And if you put a little bit of money in every month, you have probably made a good profit. Now, when you buy stocks, there are different kinds of companies, and some of the more traditional companies, they don't just, or you don't as an investor just look at how is the price for the shares developing, and hopefully we're all hoping, if we are invested in the stock market, that the share price increases. But in many cases, these companies that are traded on the stock exchange, whether it's the Nasdaq or the Dow Jones or the Russell 2000 or whatever other stock exchanges you go and have stocks in, these companies also, because you are a partial owner, if you own shares, you are a partial owner of that publicly traded company, they also let you participate in their profits. So if a company makes profit, then the owners of the company, meaning the shareholders, get a certain percentage of that profit, and that percentage, this money that they send to you, is called dividends. Now, in many cases, you have the option to say, instead of sending me money, I just want that same amount of money. Let's say you have $1,000 stock, right, or $1,000 worth of stocks in a company, and they pay $100 in dividends at the end of the year. Now, oftentimes they say, give you the option, you take that $100 and buy more stock, right? You may have, let's say, 20 stocks worth $50 each, so that's $1,000. And if you get $100 dividends, you can buy 2 more for those $100, so now you have 52. And next year around, all 52 would get a dividend. That's one thing. But theoretically, you could also say, no, I don't want to buy extra stock. I want to get the dividend in cash, and you get that onto your account. And again, you can take the dividend and put it into your accumulation account, because it would help you to get to your investment amount of anywhere between $15,000 and $25,000 for the first house or the next house in the sequence faster. So dividends is another way of income that you could get. Now, we are all working to buy properties, and yes, I'm oftentimes talking about how do you get to the point when you can buy your first property. You just heard me say anywhere between $15,000 and $25,000 you will be in a position to buy your first property. But let's just say that you have already done this a few times and you have 3 properties. Now, these 3 properties are rented if you do it the way that we recommend. And so you have your rental income, you pay your mortgage, your property tax, your insurance, your reserves, your capex, your maintenance, and your property management. And then when all of that is paid, you still should have, if you do it right, if you follow our strategy, you still should have somewhere between $200 and $300 what's called passive income or positive cash flow. And so that's another income that comes in, and that's the passive income that we ultimately want to get enough of, so we don't need to do any of the other income forms anymore, but it comes from your rental income. So that's a form of income. Now, if you happen to be somebody who got divorced and you had a relationship that fell apart and you had a certain lifestyle and you were the person who had the lesser lifestyle when you came into the relationship, the other person had the more valuable lifestyle, then what the courts typically do is to say, okay, the one person has to pay the other person alimony to maintain the lifestyle that you were used to while you were together. The other way that there could be alimony would be if you in that relationship had kids and you are responsible for the kids, then the other partner is supposed to help you financially to raise the kids. Alimony in that sense is also a way of income. Now, the next thing is we talked about the stocks that you invested in and you hold, and then you get dividends. But what can also happen, I mentioned earlier, the stock market has been doing really well in the last 10, 11 years. So you might say, every good thing comes to an end at some point. So I don't necessarily want to believe that this is just going to continue forever and ever, and I'm not greedy. So I've had a really good run for 10 years, and half of the stocks that I've accumulated, I want to sell to secure the gains, the profit that I've made. So let's say you decide 50% of what's in your stock market portfolio you sell. So then what is actually looked at is how much did you pay for each one of those stocks when you bought them, and how much did you sell them for, and the difference is your profit, but the government looks at it as what's called capital gains. And why? Because they say, okay, you put a certain amount of capital in, this capital sat on the stock market in these stocks and gained in value. And when you actually pull this gain out by selling the stocks, it's called capital gains. And right now we have in the United States a capital gains tax, if you have it for longer than a year, of 15%. Now there are some things going on where the government says we might want to increase this, but right now that would be the case. So you would get the money from selling the stocks, then you would have the gross gain would be the difference between what you put in and what you got out. And then you have to take 15% taxes out. And that would be then basically the form of income after taxes is your gains. How much did the value of these shares actually increase while you held them from when you bought them? So capital gains. Now, if you have a business, and you would understand immediately how that comes in business, yes, theoretically, you can pay yourself as if you were employed in your own business, but in the more common way, businesses make profits. And I mentioned earlier when we talked about dividends, if you have a publicly traded business, right, and the business is actually issuing stocks, and other people that are not in any way otherwise related to the business, they invest into the business and they buy stocks, then they get dividends as income. But if you have a business and you are the business owner and it's not publicly traded, that business operates well. You did a great job managing it and the business makes profit. And that profit is a form of income as well. It's business income from profit, not because you're an employee, but because you're an owner of a privately held or non-publicly traded business. So that's another form of income that you can have. Now, if you, for example, like me, served in the military, I was in the Air Force for 22 years. And through this time, I earned the right to receive a pension, right? So that's one other way of income is pension income because you did a job and you accumulated. Now, the most commonly known form of that kind of pension income is Social Security, right? You're paying every time in your normal salary job or in your hourly job, you pay a little piece of what comes in as gross income and they deduct it into the Social Security account. And then when you're getting into your 60s, you are eligible to receive Social Security. So that's a form of pension. But if you work for the government, like I did in the military, you can get a pension. And it used to be, it's not that common anymore, but it used to be that businesses, large companies like, General Electric and railroad companies, utilities companies like PG&E and so forth, they used to have plans where you could opt as an employee to say, I want to put a little bit of my income into the company pension plan, right? So they basically, what we call today retirement plans, but at the time before these modern retirement plans came in, there used to be pension plans where you could put some money in, your employer put some money in. In Germany, for example, they do that 50-50. And then at the end, when you're basically saying, okay, now I'm retiring from this job and I'm 60 or 65, 67, you're not just getting your Social Security as basically pension and retirement money, but you also get money every month out of this accumulated amount of money that accumulated over time. And you can imagine these big businesses, if all the employees paid into the pension plan, that created large amounts of money every month that the business could actually invest on behalf of the employees, much better than what you as an individual could ever do. At least that's how it used to work. Okay, so pensions and Social Security is another form of income. And one that doesn't really help you, that's the kind of exception to the norm. All these other ones that I mentioned so far, so your regular jobs, wages or salary, dividends, rental income, alimony, capital gains, profits from your business or pensions, those are all incomes where you can say, I take a certain part of it or theoretically all of it and accumulate it into my accumulation account. And then whenever I have anywhere between $15,000 and $25,000, I buy another house. There's one more that I want to mention because a lot of people probably aren't aware of that. If you get scholarships, it has value, right? So when you actually file a tax return, the fact that you didn't have to pay anything out of pocket doesn't mean that you didn't receive value. And so scholarships is considered a financial benefit that you receive because otherwise you would have had to pay for it. And because you had that and other people didn't have that, it is added into your tax return and can theoretically reduce the amount of money that you have left over, or increase, if you want to, the amount of money that you have to pay on taxes. So those are all different kinds of income. And the real message is not just to be aware, what do we mean when we talk about income as the first letter in our word ideal for ideal wealth grower, but also to be aware, look at all these different places and do you have any income from them, or would it make sense to look if there are any opportunities for you where it would be beneficial to start looking if you could get income from any of those places. And ultimately what we want to funnel together is to increase the amount of rent income as much as possible and reduce all the other ones. And when your rent income is high enough, then you don't need the other ones anymore. And you can live off this passive income that people that live in your properties pay you. So that's the situation and the meaning of the I in ideal wealth grower and the I standing for income, and what the different kinds of income we actually have and should consider when it comes to where would I find the money to put into the accumulation account so I can sooner or later start and then keep investing into properties until I reach my time freedom point and have so much coming in that I don't need to exchange time for money anymore, any of these other methods that I just described to you. So I hope this was quite informative for you. In the next couple of videos, every so often I will go through the next letters in the word ideal and get them a little closer to you and explain what is the deal about it, how do they fit in, how do they benefit it, and what are they in the context of the strategies. So when we say we want to encourage you to do the out-of-state turnkey residential real estate investing strategy, the word investing in that naturally means you want to buy something. And the real question is, where do I get the money from? And the starting point, and that's why I is the first letter in this whole sequence of idea, is it comes from the income, whichever form, and ideally all kinds of different forms of income that you can tap into. So with that being said, if you're not already a subscriber, I would love to ask you to become a subscriber. If you like to get notified when we have another video, ring the little notification bell. If you like the video, give it a thumbs up. If you want us to do some other content or more expansive content or change the topics, please put a comment in the comment section below the video. And one last thing I want to mention is we are looking to actually find people who like to talk about real estate in an interview type setting where we have, like myself and any one of you who likes to have a conversation about it. We put that on Zoom. We basically do a little recording and then post it on our channel here like these other videos, so that more people can see what is interesting in real estate investing, why are we doing residential real estate investing, and so forth and so forth. So if you are interested or know somebody where you would say, hey, this would really be a cool interview, can you interview this person or that person? Or you raise their hand and say, hey, I would be interested, I have all kinds of questions I would like to talk to you about, then please let us know and we reach out to you, and when we see that we set something up so more people can benefit from the conversation and from the questions and the answers. So with that being said, be well, stay safe, and I see you in the next video.